Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Rob, welcome to the Australian Investors Podcast.
Thank you, Owen. It is weird being on this side when it's usually me hiding behind the screen when you're on the Selfwealth Live weekly. So it's good to be here and do a little bit of an admin reveal.
Yes, for the thousands of people who watch Selfwealth Live, we are joined by none other than Rob from Selfwealth. Yes, that is right. The Rob from Selfwealth, mate. It is an absolute pleasure to have you in front of the camera for a change.
Appreciate. Someone yesterday was saying face for radio, and I appreciate you saying that it wasn't. Thank you for that. And also finally good, I think, to get to have some face-to-face with some of the viewers.
Yeah,
you know?
Yeah, it's great, mate. Thank you so much
for
joining.
This is who I am.
Here's a real person if you are watching on YouTube. If you're listening while driving your car, do not get out the YouTube app. Wait till you get home and check out Rob. Mate, we do Selfwealth Live each and every week.
Wednesdays, 6 p.m.
Wednesdays, 6 p.m. Be there, or not, but you should be there. Thousands of people, tens of thousands of people have tuned in. And we'll come to that in a bit about your experience and how you moved into this industry, because you're not from an investing background.
No.
So we'll talk about that in a moment. But for folks who on the off chance have not heard of Selfwealth, can you set the scene for us?
I can, and I'm hoping that it's a very slim chance considering a lot of the awareness branding that we've done with Rask over the time. So I'm hoping your audience at least is familiar with Selfwealth. But for those who don't know, Selfwealth is the original disruptor of exorbitant bank brokerage.
Yeah.
We've been around for 10 years. We've been listed on the market since around 2017. And that's something that is different and special to a lot of the other incumbents because they don't have to be as transparent with their numbers as we do. And that's something that we pride ourselves on. We have attracted a good amount of what we call established investors because we have a flat fee brokerage model. And also of those investors that have come on, we have jumped into the top 4 spots in the Australian investment space. So we're the first ones to actually bump one of those big 4 banks off the top 4 podium and jump and take some of that space. So we've got 129,000 active investors. The keyword there is active. And we have about $9.3 billion funds under management. So that gives you an indication, if you want to do some quick maths, of the average portfolio size that these people have on Selfwealth.
And it's really interesting because we've seen a huge foray of people moving in to investing for the first time and a lot of new brands kind of taking some of those newer accounts, much smaller balances. And you actually, and we'll cover this in just a moment, you were telling me about this. You have some industry data which you're going to share with us today.
Yes.
About the number of people who have maybe quote unquote disappeared or become dormant, as the industry would put it.
Yep.
But is there anything else other than fixed cost brokerage that you think has made Selfwealth such a success?
Well, look, Selfwealth, we really took off during that COVID time. So we were around before then. And then when COVID had that huge investor boom, a lot of your viewers, a lot of your audience will know that the market was performing very well then. And I'm sure you'll know that the investment space, the amount of Australian retail investors doubled over that time in 2020. And Selfwealth captured a lot of them because at that time it was just some of those big banks. You were having to pay large spreads on some of those large trades. There were, in the months to come after that, we had instances like the GameStop debacle, saga. At those stages, a lot of platforms were going offline. They were having outages. Selfwealth was not one of those. We also didn't stop people from trading GME because we feel it is weird to just stop investors from trading things that they want. But over that time, we did get a lot of that Australian investing market. And I think it is, well, my job in the marketing space to then try and get these people to do what they have committed to get the best practice investment education, to do the things that are going to be better for their portfolio and their well-being over the long run.
Jeff Bezos had this saying that I was watching, because you know how obviously anytime there's something new and innovative on the cost front, there's a certain type of person that rocks up in the beginning, and he would say, like, when you have Prime free shipping, it's like the buffet. If you offer a free buffet, the first people to rock up are the really hungry people, the people who eat a lot, right? And when you offer fixed cost brokerage, which is super innovative at the time and probably still is, in fact, it still is, a lot of the people that come are people that have big portfolio balances, right?
Definitely.
And they're like, well, traditionally, in the past, this might have cost me hundreds or maybe even thousands of dollars, depending on the size of my single trade. And then here comes Selfwealth at $9.50 a trade. I guess my question to you then is Selfwealth just a platform for people with huge balances?
Definitely not. So if I was touching on the COVID space before then, we got a lot of that investment market, and we got a lot of those people who are new to the investment market. So we've got a lot of those people in their 30s or their 40s. They might be using investing to save for a property. Yep. They might be doing a fledgling portfolio. I think there are people, and look, you've been investing for a long time. I have only been in it for the last few years or so. But I think within my friend group or those people that I know, anecdotally, a lot of people see themselves as someone who is going to be an investor. You know, even if you're not in the stock market, a lot of people think, I'm going to invest one day. You know, like it'll happen one day. And a lot of people just need that that nudge to get that impetus to do it. COVID was that. We have a lot of those people on Selfwealth. And something I like to say is that Selfwealth's investing spread, our investors, of that 129K is fairly representative of the Australian investment landscape, just in general. That's why I say when I come to do any of the stats on our millionaire investors or the stats on what we're trading in US, the stats on what we're trading on the ASX, etc., these things get picked up by a lot of media because we are fairly representative. And fairly representative means that we have a small sect or smaller sect of people that have those high net wealth, just as the population does. You know, there are a lot of rich people. They throw out the average wage, average salary, but there aren't as many of them as that middle band. So we still have a lot more of that middle band who are, you know, starting out their portfolio. They're not, a lot of people see those investors, especially in the investing space, as being kind of like newbies or just not as sophisticated as the others, because you've got these people who are making these big trades. They've been in this business for a long time. And then you've got these others that are coming in and they're seen as lesser just because they are the least. But that's far from it. Within Australia, they're a niche. You know, there aren't that many active Australian investors. So they are a niche. They know a good amount about investing, or usually enough to get into it. And they are, compared to their friend at the pub, they are seen as the investor. Even though we see that broad band of the 30s to 40s who have like, I don't know, 10, 20K in a portfolio, trading once every like month, those types of things, just topping up, dollar cost averaging. We might see them as a smaller group, or like maybe not as important. I'd say they're much more than the average Australian.
Yeah, that's actually a really good way to frame it. And I think a lot of our industry does think about that in the sense of like, well, the quote-unquote retail investor is less sophisticated. Yet a lot of the studies show that some of them do exceptionally well. I know, you know this, every week we would do on the Selfwealth Live program, we would do the top 10 most bought and sold. And of course, you get some of those meme stocks in there occasionally. But a lot of it's just like really simple, long-term focused investing, which is just what we want to see, basically.
Yeah, when we were doing those, we used to do those top 10 trades, and this is a little bit of a deep cut for the Selfwealth Live viewers from maybe 6 or so months ago. But when we were doing that, we'd always try to, unless it was something a little bit spicy, a little bit salacious, we'd always try to take out VDHG, VAS, A200, NDQ, because they were always just the top. You know, they are what people invest in more than anything else. So we'd try and take those ETFs out and talk about single stocks, because they are somewhat more interesting than people who are just doing the thing, which is actually by far the best thing that you can do. You've shown me enough graphs on Selfwealth Live about dollar cost averaging outperforming every single other method.
Yeah, of course. So speaking of, one thing that I might just put you in the hot seat for a bit of a hot moment here, Rob. So your background is marketing.
Yes.
Right? And you've landed at Selfwealth and you've taken on the role head on. What have been some of your learnings coming at it from someone who is from a marketing background, looking at investing? And even I'm going to ask you the question because I know you want me to. You probably don't want me to ask you, but I'm going to ask it anyway, which is around how your investing has gone so far.
Go on.
Okay.
Okay. We'll touch them. We'll touch on them in pieces. I think coming to investing as a marketer, right? You do see it as being something that's a little bit scary. I think you have something that marketers think about a lot in like biases, right? And the things that you have, the levers that you can pull, or to try and get people to act in the way that is best for them. Before that, you've got, say, like the loss aversion. You've got confirmation bias. You know that trading is just for what you've seen on Instagram, which is people spending their entire life behind 7 screens looking at investing tea leaves for different shapes in charts, etc. But coming to investing is the main learning is that it's a lot more boring doing the thing that is you need to do. That dollar cost averaging, that is the harder thing, I think, for us to get across. And this is something that I like to communicate is our job within the investment education space is like making people floss. You know, everyone knows that you have to floss. People know that if they continue to do this just little bit by little bit, like low effort, like may take you like 2 seconds to do in your day, but then by the time you are 60, you're going to have this asset, right? You're going to have your teeth. You're going to have something that'll immeasurably make your life a little bit better. But it is really hard to relate that to the 5 minutes or so before bed. You know, it's very hard to convince people that your financial well-being and then probably your quality of life in your 50s, 60s, 70s, whatever it's going to be, your FIRE number for those people, all it really takes is a small amount of investing done regularly. The numbers are irrefutable. The numbers are like, there is a mountain of data out there, a lot of which I've seen from you, showing that there's just those little things that you need to do. What were the other ones that you were going?
So what's been your most memorable investment so far? Okay, you've only been doing this a short time, but we've all got them though. So what is it?
Yeah, I think I know what you're aiming for here, and it's something that I've brought on I've griped about, whined about on Selfwealth Live a few times, is my CRIP investment, which famously did not do too well for me. I was talking to someone in the chat of the live recently, and I was saying CRIP. So for anyone who doesn't know, this is the beta shares CRYP ticker code, and that invests in crypto
innovators. They call
innovators. Yeah, that's the thing. And when it had, sorry, I was speaking to someone recently in the chat, and I was saying it's up 109% year to date. Just a pity that I did not buy it at the start of the year. So yeah, famously, I think I sold at a loss, and I think I bought for maybe $12 or $13. I might have sold for $2. I couldn't bear it anymore.
Welcome to the stock market.
I couldn't bear seeing that red line on my brokerage every day when I log in and just had a little look. I'm like, I can't do this anymore. It's got to go. And yes, I did sell it before year to date when it started going back up. So
oh, that's good.
Yeah, you live and learn.
Sorry to hear that, mate. But okay, so other than that harsh lesson, which is so common for people, typically we all have one memory of our starting out in the stock market, which is we either do well and we remember that winner or remember the loser. Like, to be honest, most people could probably put their mind back to that. I remember my first winner was Telstra of all shares, and that was just pure luck. And thanks to that, I probably was able to...
confirmation bias.
Yeah,
you know?
Yeah. What else have you learned about investor behavior in this time? Because a marketer's role is basically to dial into behavior and what's going on, in, like you said, in biases in people's brains to make a decision. What have been your broader learnings?
I count myself as blessed for coming into investing as a marketer because, as you say, it's all about finding the psychographic, that could be like the behavioral influences, the demographic, so age, gender, location, those types of basic things, and then also going into data that might be qualitative or quantitative to just understand the Australian investor. And that is about the best way to learn about investing generally. I believe. Also blessed to be paid to learn about investing to start.
Yeah.
I did a recent podcast on the Selfwealth podcast, just to advertise a competitor on the show, just as you do to me sometimes on the Wednesdays and the lives.
Love
we spoke to Frances Cook, and she said that one of her favourite investing things about getting into investing was because she did it as a journalist and she got paid to do it, and then she found that love for it. And that's exactly the same way that I've come into it. One of the main learnings, I think, is that on the broader side, generally, Australian investors do what they are quote unquote meant to. So that would be investing in those small pieces. But that means that it also shows that there are a small amount of people who do the higher trading. It's not all the flashy charts and charting and technical analysis that can be quite daunting. A lot of people just do the thing, go buy and buy, collect their dividends. They might have a broader ETF portfolio, etc. But I think blessed also as well to have a lot of the insider industry analysis that is not available to the general public, not even available to a lot of other companies, because a lot of this data is very expensive to get your hands on. And I think it gives you a good idea of what is happening in this market. The market's quite cyclical. You get to see, or I get to see on Selfwealth, what the investors are doing daily. That's quite nice.
Yeah.
I've reported on, say, I've got one of reporting on the millennial millionaire investors. I think it was at the start of the year, and I don't have the stats in front of me, but it was Leo Lithium, I believe. It was ticker code LLL, and we're seeing a big influx in these millionaires, these serious people making serious investments. We're seeing that they were buying into LLL, and I'm looking at the chart. I'm like, hold on, this is down, has been down for a while. No real news out. Don't know what's going on. And then a month or 2 months later, the stock has had this turnaround. It's just starting to churn, go in the other direction. There have been a few of those that I've seen from just looking at some of the larger traders and learning from them. This isn't magic. It's just people who maybe have done a lot of research, and that is a conduit that we then give to our investors. So I'll report on what those millionaires are buying, just so then our other investors can say, is it for me? Is it not for me? Don't know. Might be.
Yeah.
Am I going to be speculative on this? Maybe not.
Yeah.
Yeah.
I think that's great. You obviously have access to heaps of data, which is great. And I remember when we did the top most bought ETFs, shares, whatever, US stocks, it was really encouraging for me to see that. And I think we'll come to it in a minute, but the lack or the falling number of financial advisors in the country has given birth to this huge demand for education around investing.
100%.
And that's great for us. It's great for you because we can fulfill that need. But it's great to see that some of the wisdom that's just simple ideas about how to create wealth are really starting to show through. Whereas say 20 or 30 years ago, maybe not so much. And that I think speaks to Selfwealth. We can just talk about that for a second. You and I working on that for 18 months, 2 years now.
It has to be 2 years. I think we're up to 2 years. Yeah,
oh, wow.
I believe we've been doing this for quite a while, or it could be maybe 23 months. But look, nail on the head, there is a desperate need for that financial education within the space, especially for a lot of people just coming to the market and wanting to know what to buy, what to trade. You cannot tell someone what to buy and what to trade, even if that advice is just, say there is an ETF that's performed well for a decade. It follows all the basic principles. And you can't tell them for a very good reason. ASIC, the regulator, has got some rules in place that you can't tell people what to do, because people will then abuse that and tell someone to buy a stock that could be a little bit too speculative for them. It can ruin some lives in terms of the finances. But say we've had a recent rule around the finfluencers that we can have, because we've had a few bad actors that meant that people weren't allowed to advertise investment education, but that also just means that it's out of the public conscience, I feel. You're not going on Instagram and seeing people talk about what to invest in, just general approaches to investing as much, because people are scared. And that puts the onus on people like you and me. We have to bring up this bulging middle of investors and teach them the basics. As you say, good for us, I guess, because it's like taken away that pull. But also there is the double-edged sword in that while people like you and I are some of the few providers of this education, or those that have managed to get licensed since, the interest, especially in a cyclical market when the stocks are down and the environment's tightening a little bit, people don't have as much cash, the interest isn't there as much.
Which is such a shame because you want people to stay on the roller coaster at this point.
Yeah.
Especially if they're long-term accumulators.
Straw hats in the winter.
Yeah, exactly.
Yeah.
So we were looking at the numbers before, about 11,000 subscribers to YouTube, which is pretty insane.
I think it is 10.9 something thousand on the YouTube.
Rounding up, of course, over here,
We'll
Mr.
go,
Owen
we'll go
rounding
11K. Yeah. And that's also just representative of the need for this stuff. So look, you and I are doing this thing every Wednesday. We were up for one of the, I think it was Financial Education Campaign of the Year pretty recently, alongside like AMP and BlackRock. AMP, BlackRock, and then this thing that you and I do on a Wednesday. Like, it's incredible, but it just shows that there's need for what we do. We've got this engaged user base. We've got like thousands of people watching, plenty of people jumping in on the actual live chat, which is some of the fun of it, and rating your jokes. Also, by the way, you said when I was going to jump in that I could do a dad joke. You do a dad joke on my show every week. Why can't I do one on yours?
Do you have one?
Yes, I do. I do.
Okay, give us your best dad joke.
Why did the bicycle fall over?
Well, I don't know.
Any guesses? No?
Because there was no one pedaling?
Because it was too tired.
Oh my gosh. Too tired. I get it. There's multiple layers for that one. I have to think. I'll give you a 7 out of 10.
7, harsh judge.
I get a lot of 1s or 2s.
I gave you a 2 last night. I'm sorry. It wasn't cringe enough for me.
Okay, so the next question I have for you is something that you're privy to that I'm not as privy to, which is this idea of viewing the world of, let's just take the brokerage wealth management platform industry, right, as the whole lens. We've heard some huge numbers thrown out about the number of people that are starting to invest during COVID, but you've been telling me lately that there are some numbers that look like it's the other way around now, as in some people have maybe left or have stopped trading. And we know this anecdotally because a lot of folks are tight. They've got their family budget, right? Their interest rates have gone up on their mortgage, so their rent's gone up.
RBA's doing the thing.
So, they're all just struggling.
Yeah.
So they're not investing as much. What can you tell us about this?
Well, within the investment space, there's a lot of reporting on the amount of investors that Australian has. The ASX has rightly reported on the growing amount and saying that there are a large amount of the Aussie investors, more than ever, et cetera, and that is one view of looking at it. That's looking at the amount of Australian investors that at some stage have bought an equity. Yeah. That doesn't mean that they're really active investors, I would say, because they might have gotten equity 10 years ago, 20 years ago. They might not have opened their portfolio in a while. They're not what we would call investors because they're not actively doing the thing. Yeah. There is a company called Investment Trends, and they do a report that is global. It goes across a number of markets, and say within Australia, a lot of the larger players like Selfwealth, the big banks, other incumbents, anyone who wants to participate will put their investor numbers in. So then these people go along and they analyze it, and they have a look at the actual number of investors who have been trading, and it's reported on some surprising numbers in the actual amount of Australian investors. If we're talking about active, and we're characterizing that as people who have made a trade in the last 12 months, which, look, it's not even that active in terms of what a lot of people are really doing, especially on the Selfwealth platform. We went up to about 1.5 million in about 6 or so months ago. But in the last 6 months, over 400,000 of those investors within Australia went dormant. So
haven't traded.
Haven't traded in 12 months. So in that 6-month period, you could almost say it's nearly a third of those active Australian investors left the market, just completely disappeared. But that obviously does not mean that there are only the other 2/3 left. You get other people who used to be dormant coming in. You get new investors coming in, people reactivating portfolios and doing the rest. But it is highly indicative of the RBA tightening.
Yeah.
So, and it's something that I don't think anybody's really been speaking about in the media at all. That a large amount, like, look, 1.5 million of them, we've lost nearly a third that just decided to not trade. And naturally, they've got higher mortgages, they have other things to spend their cash on, and maybe topping up that ETF portfolio, whatever they're doing, is not it's not getting food on the table, those types of things. I think the thing that speaks to for companies like Selfwealth is that we have got a lot of those larger portfolios or those more like established style of investors. We still have some of those that might have gone dormant in the last 12 months or just maybe like traded a little bit, but we also have retained and kept those serious investors. So those are the ones who have stayed in market because they are the ones who have seen a few cycles go through and they know, look, this is just a cycle. I'm going to stick to my investment thesis. I'm going to do what I intended to do and just invest through the downturn, which is, just keep buying, as some would say.
Yeah. You, at Selfwealth, you also have a lot of self-managed super funds on the platform as well. And those types of vehicles and accounts would be continually investing because they're getting benefits from, the super contributions and all of that as well. And they want to keep buying and whatever. So there's multiple reasons why those more affluent investors, those established investors, will keep buying throughout this market cycle.
100%. I think it can be scary, right? Like,
yeah, for sure.
I know all of the things. I teach people all these things, but there still might be a month when I'm like, maybe I won't buy this month. It's hard, even when you know to floss, to make yourself floss. You have to understand that people are human. They're not just robots, which is why. Say a lot of the people prefer to have like maybe a fund that's just managed by robots. We're not quite at the stage where ChatGPT will sort our portfolio out for us, but that's set and forget. Stick to the philosophies, do your thing, stick to your thesis, etc. That works.
What about then in the international context? So you mentioned there like investment trends can look broadly across the world, and they do. And I get some questions about this. We have people that listen to the show that are not Australian, even though it says Australian Investors Podcast. We've got a lot of Kiwi friends, of course. Thank you very much. But we get people from the USA, from Canada, UK, Singapore, Hong Kong, listeners all over the world. There was even some in like sub-African countries that I've never even heard of. I don't know if it's just an Aussie on work trip or something like that. But
you've got someone flying out of Canberra.
Someone's over there doing something. But can you talk to us about the key differences, or just maybe not all of them, but just even what you think about when you think about Aussie versus, say, international investors? Yeah,
definitely. And I don't really know if it's just me being in this space, so I think that it's somewhat intuitive, but Australians aren't big on equities, regardless of some of the numbers that might be out there. We're not as big on equities as other things. We obviously love home ownership. We have superannuation. But in terms of that global space, look, COVID maybe moved the numbers a little bit to not out of the normal. So if you look to the numbers beforehand, Credit Suisse did, RIP to Credit Suisse, did a wealth report that they were doing every year. And what they'd look at is the proportion of wealth by countries. And I'd noted that Australia is like, they're up there in terms of the amount of wealth that they have. But we are the anomaly globally in the amount of equities that we have, because I think it was the average portfolio at that time, 2019, granted, it was about 19% or so of their portfolio was in equities compared to a global average of about 29%. And then if you're looking at the amount that they had in what Credit Suisse defined as, I think it was just other financial instruments, but other in most countries made up of pension, made up of superannuation. So it was something along the lines of 30 to 34% was the global average, but then Australia had about 60 to 64%.
Wow.
So it's a lot of money that is in a lot of money in super. That's, look, not a bad thing, but then also a lot of money in property. So something that also came out of that 2019 report was Credit Suisse saying that Australia was some of the biggest losers in terms of their wealth because they're so reliant on property, not diversified, as you would say. And when those property prices went down, their average wealth dropped a lot.
Yeah.
There's also,
That's
I think,
so interesting, isn't it?
Yeah. Like something that I feel like maybe you and I kind of like know intuitively a little bit, but yeah, the rest of the world invests more in the stock market. And look, if you're subscribe to any of the Danny Kahneman beliefs or anything like that, there's going to be a gravitation towards the mean. Like globally, we will eventually have a more average way that's investing. And I think Australia is going to go to that point as well. So Australia, I personally predict, will then have more of their share of their portfolio, their net wealth, in some of those equities. And look, I do believe that's a good thing, because then no one will be calling us losers when our property prices go down.
Well, it's probably a good thing, right? It is. And I remember there was a Credit Suisse report that I read, a similar thing, but it just looked at stock markets overall and the performance of them. So going back many years. And the number one country that they surveyed of all the countries that they surveyed for stock market performance over the ultra long term was Australia. And they called it the truly lucky country. So to have such a good performing stock market and people to be underweight the stock market.
The stock market performs so well. It's so resilient. Like I've got a brother in London. I was looking at the FTSE over like the last year or so, and it has been undulating. Looking at the NZ50, it has been undulating. But because we've got materials and resources that do so well, like it's interesting that of all the countries that don't invest in stocks that much, it's Australia. And then we have franking credits. Like it's just this little oasis for us, and a lot of people aren't privy to it or like aware.
They don't have the context.
Yeah. But like also on the other side of that, when talking about the other dormant numbers, across those other maybe developed countries you'd like for stock markets, so you go Singapore, France, the US, England, all of those types. Australia had a higher percentage of investors that went dormant compared to others, because it's more within just their normal, I guess, public conscience, the way that people act. They're like, oh yeah, investing, we know the thing, we understand, we keep doing it. Yeah. But Australians got scared and they like pulled out in a large number. So that's a lot of those people who would be smaller traders on those like other types of incumbents, like doing a little bit here and there. Yeah. Those people got scared and pulled away.
So that's, again, such an important education piece. I'm going to be biased towards this, of course, we probably both will be, but like the education piece is so important for people that are trying to navigate that part of their life early on. Okay, so I've got probably two more questions for you. They're more on the marketing side, because that's your forte.
Yeah, hit me.
When you think about how the investments industry is marketing to us, so as consumers, we are the investors, we are the consumers of this content and the marketing, how do you think about the landscape generally?
The thing that I think about the landscape is maybe people should know as non-marketers is that, like with any trade, marketing has some tips and tricks, etc. And something that works in most markets is a thing called ESOV, excess share of voice. Share of voice within marketing is the amount of advertising that your company could have in market per se. And then that share of voice is taken of the companies in your category, could be in that finance space. So if you were just looking at those big four banks, you got that share of voice. Comsec probably, or Combank will have that, 40 or so percent. And then you might have like NAB, and then a little bit from like ANZ and Westpac. So those have those share of voice in terms of their spend, right? Excess share of voice is a marketing tactic that is shown and proven to be effective in a number of markets over a number of years, where if you take your share of voice and you've got 10%, say, if you then have 20% of your share of voice, so you up that, or sorry, I'll reframe that. If you take your share of market and your share of market is 10%, if you then up your share of voice to be above your share of market, so you've got 10% share of market, you go 20% share of voice. In that 3 to 5 years, your market share, and then for investors, that company's market cap will improve, that will increase. And that's why we have so many Australian investors, I think, that go to Comsec, because in some elements, it's the biggest budget that wins. It's the ones that you have the most, it's called availability. So they've got both physical availability and mental availability. And the thing that I would point out to investors there is that you are not immune to marketing. There's a thing called the mere exposure effect, where just by seeing something more, you like it. A lot of people are familiar with some of those normal kind of low-level biases that just like, pop psych is proliferated. By seeing something more, you will like it more. You will be inclined to then put your share of wallet, and you'll be inclined to put your portfolio there. I think just with investing, how you can get emotional with things. I think it's always best for the person when you're choosing who to invest with. If you're just coming to it, or if you're in a platform right now, like, look, like, what types of trades am I making? Am I doing micro investing? Am I doing those larger trades? And am I maybe just influenced by the thing that has been most physically available to me because I can attach it to my bank, or just mentally available to me because there are a lot of companies out there that'll spend big on billboards. I think there's something to trail on from that, and something that I'm very interested in is kind of using marketing as a predictive element of what will be happening within the market. We can't predict, past performance is not indicative of future performance.
Yep.
General financial advice warning, please insert. But you can look at things like the spend that some of these larger companies have been making. So you can look at there are companies that marketers like myself might use, say big data, BIG-DATR being one of them, and you can get an indicative view of the amount of ad spend that someone has been spending over that previous quarter.
Which is really cool to be able to see what these big firms are spending on marketing.
Because also, if you think about them doing a marketing strategy or campaign, they're doing this months out, right? It's not something that they're all doing ad hoc, or they really shouldn't be.
Yeah.
And you can see that if there is an increased spend by people like NabTrade and CommSec, which there have been over the last 3 months, NabTrade I think is in the 90% as per big data numbers, and CommSec I believe about in the 18 to 20 or so percent. You can look at them increasing their percentage spent on advertising spend as them seeing the market as being maybe at a turning point, or at least some people with a lot of this industry data are looking at the market. These banks have these financial analysts looking at the market and could say, hey, now is a good time to spend on these ads because people are going to be in market. Like that, no one's advertising for lawnmowers in the winter, People are advertising for the thing that's coming, right? That can be somewhat of a little signifier to look at the market and say, hey, look, there's a lot of, and people will also see there have been a lot of other people that come in. You'll see a few more billboards at the moment that are on in the investing space. And you can say, hey, look, is that a signal to me that some other people think that the ASX or just the investment landscape is about to turn around? Does that mean that there'll be more people getting into the market? Does that mean that there is any time to start trading? Of course, now is always the best time. Best time to plant a tree is yesterday, etc. But I think that's something that I use as a little indicator, and I find it quite interesting because I'm a bit of a marketing nerd. So
it's actually really interesting to me too, because as someone who's studying companies to see if they're spending, like you typically take incumbents or the companies setting strategy as kind of the experts, the domain experts, at least they should be, because they're the ones that have the experience and they offer the service. So I really do like that.
Yeah.
And I think it makes a lot of sense to look at all companies that way. And I think any analyst that's now listening to this could probably go and get a big data subscription as well and be like, what's going on?
There's another one that you can also assess slightly. So there are a couple of marketing dudes that marketers will know. You got Liz Burnett and Peter Field, and they've got this thing called the long and the short of it. So long-term marketing and then short-term marketing, often referred to as brand being the long-term, and then short-term being performance. You're talking about YouTube ads, social ads, et cetera, et cetera. You can see that a lot of those companies, when they are making a big play, they'll do the brand. That's the adverts that don't have an exact click to acquire that customer. Those things to build an association in the mind. And usually when they start to spend more on that, and this goes against actual marketing practices say that brand should be on average 60% of your spend, where performance could be 40, etc. But a lot of companies, when that finance space in particular, you'll see them when they start to go with those billboards. That is when they are thinking that the market is they need to build those associations. They need to be fresh in the memory.
First, and then
when the billboards disappear and you're only seeing your cheaper ads in some instances
Facebook
on
ads,
Facebook, Instagram, that's when they're just keeping the lights on, Okay. So they're just saying, oh, well, we're not sure exactly what's happened. We're just going to go back to doing the search, the social, we'll do those things, and those things work. So that's another indicator to look at the market if you were going to
So whether they think it's like expansionary or if they're just kind of
where they're at in the cycle.
Really interesting, really interesting. So anything else that you would leave us with, or is that you're going to keep some of the secret sauce for yourself?
Look, other random little tips of the trade, things that are available to everybody. SEO, search engine optimization, is obviously something that can be indicative of what people are searching for. Easy one that people can do to look for, say, stocks or even just investment terms. Like, so if you look at how to invest, for instance, that's something that I follow to see what people are searching for, to see if they're looking for those preliminary investment education pieces. I think I recently noted that how to invest had been declining from about like May through to July, but then in August it saw like a 55% spike. So that to me tells me that within Australia over the last few months, a lot more people have been searching for those terms.
Interesting.
It could be a time that a lot more people are going to be coming into the market. You've had a few RBA pauses.
Yeah.
More things could be coming in.
That's really interesting. I'm going to have to dust off my old SEO playbook, just like brush that one off and then have a look at
HubSpot.com, semrush.com.
How to invest. I really like it, mate. Well, Rob, this has been a fantastic admin reveal. My first ever admin reveal, to be honest. And I've got to say I'm proud. It's a proud moment for me.
I'm honoured.
And I can't wait to keep the chats going online. If you're wanting to tune in and chat with Rob, you know where to go every Wednesday. Mate, this has been heaps of fun. I know, folks, I'll put a link in the show notes to your LinkedIn, to Selfwealth. You can join Selfwealth, and you get free trades, I think, when you sign up. I could be wrong about that. Am I just speaking out of turn?
You can go into the link in our YouTubes, and there will be 10 free trades in there. But that is a referral link, So if you just join normally, so a little bit of secret sauce for people, go to the YouTube link instead. If you're going to go sign up to Selfwealth, go into our little YouTube link. We've got a 10 free trades link there for you. You can sign up, and that's about $100 worth of trading that you'll get.
I might even just copy and paste that one over into here. Yeah, interesting. Well, thanks, mate. I do really appreciate you walking across the city, getting your coffee on the way over, and doing this with me.
Thanks so much for having me. Weird to be like visible and actually talking to you, not behind the camera, but
watch out. Now the whole community is going to know who you really are, mate. You're going to be famous walking down the street.
Yeah, the next live session is going to be an interesting one.
No, mate, it's heaps of fun. Thanks for joining me.
Yeah, thanks, mate. Cheers.